If you're trying to decide between Perth and Melbourne for your next investment property, you're facing one of the biggest strategic dilemmas in Australian property right now. Both cities are showing completely different market cycles, different opportunities, and frankly, different risks. I'm Gilbert, founder of SuburbsFinder, and I just spent the last 2 weeks analyzing over 12,000 data points across both cities to settle this debate once and for all. I've broken down everything from population growth and state finances to suburb-level performance across inner, middle, and outer rings. In the next few minutes, I'm going to show you exactly where each city sits in their property cycles, which specific suburbs offer the best opportunities right now, and most importantly, how to choose between them based on your investment strategy and timeline. Let me start with the big picture, a macro overview of what's happening at the suburb level. This requires us to look at population, migration trends, state finances, and economic drivers. Perth's population growth has been relatively steady, but here's what's interesting. Western Australia is benefiting from both interstate migration and international migration. People are moving there for job opportunities, particularly in mining and resources, but also because housing is still more affordable than Sydney. Melbourne, on the other hand, has been the population growth engine of Australia for years. It's still attracting massive international migration, but it's also losing people to other states. The net effect is still positive growth, but it's not as explosive as it was pre-COVID. From a state finances perspective, Western Australia is in an incredibly strong fiscal position. They're running budget surpluses, have low debt levels, and the state's finances are backed by mining royalties and a diversifying economy. Victoria's story is different. The state is carrying significant debt, running operating deficits, and while Melbourne has a diverse service-based economy, the state's finances are under pressure. That doesn't mean Melbourne property is a bad investment, but it does mean the economic backdrop is different. And lastly, economic drivers. Perth's economy is still heavily influenced by mining and resources, but it's diversifying into services, technology, and renewable energy. Melbourne's economy is much more diversified. Financial services, education, healthcare, and manufacturing. It's less volatile than Perth's resource-dependent economy. But it's also not benefiting from the same commodity boom that's driving Western Australia. Now, let's get into specific opportunities. I've broken this down by inner, middle, and outer rings because each segment tells a different story. In Perth's inner ring, suburbs like Subiaco and West Perth are showing interesting dynamics. Median prices are high. We're talking about 1.1 million to 1.85 million. But rental yields are sitting around 2.7 to 3.7. The growth has been steady rather than spectacular. Melbourne's inner ring, places like Richmond and Fitzroy, are in a similar price bracket, but yields are lower, around 3%. The key difference is that Melbourne's inner ring has been relatively flat over the past 12 months, while Perth's has shown modest growth. The middle ring suburbs are where things get more interesting. Perth's middle ring suburbs like Morley and Belmont are showing median prices around 800,000 to 825,000, with yields of 4% to 4.5%. What's compelling is the growth trajectory. Many of these suburbs has seen 13 to 15% growth over the past year. Melbourne's middle ring suburbs like Box Hill and Glen Waverley are in a similar price range, but yields are lower at 2 to 3.2%. The growth story is mixed, with some suburbs flat and the others showing modest increases. In terms of outer ring opportunities, Perth is showing where the real action is. Suburbs like Ellenbrook and Baldivis are showing median prices of 720,000 to 729,000, with yields above 5%. Some areas have seen more than 20% growth over the past year, driven by affordability and new infrastructure. Melbourne's outer ring, places like Pakenham and Cranbourne, are in similar price ranges, but the growth has been much more subdued. Yields are around 4% to 4.5%, but the capital growth story is less compelling than Perth's outer suburbs. So what does all this data actually mean for your investment returns? The differences I've shown you might seem modest on paper. We're talking about yield differences of 0.5% to 1%, and the growth rates that vary by a few percentage points. But when you compound these differences over a typical investment holding period, the gap becomes significant. Let me show you exactly what this looks like over a 3-year investment horizon. I'll start with an investment scenario in Perth. Let's say you buy in Ellenbrook today at $720,000. Based on the current trends, if Perth continues its growth trajectory, and that's a big if, you might see a 6 to 8% annual growth for the next 2 to 3 years before it moderates. Year 1, 720,000 grows to 763. Year 2, the 763 now grows to 808,000. Year 3, the 808,000 now becomes $857,000. That's a total capital gain of about $137,000 over 3 years. Plus, you'd receive a rental yield of around 5% throughout. Now, compare that to Pakenham at a similar enterprise of $685,000. Melbourne's outer ring is showing more modest growth, maybe 5 to 6% annually as the market recovers. Say for year 1, $685,000 grows to $719. And on year 2, the $719 grows to $755. And on year 3, the $755 grows to $793,000. That's a total capital gain of about $108,000 over 3 years, with slightly higher rental yields of around 5%. So, over 3 years, the Perth investment potentially delivers around $29,000 more in capital gain. Even accounting for the slightly higher rental income in Melbourne, Perth could still deliver roughly $25,000 to $30,000 more in rental returns. But here's the critical question. Is the extra $25,000 to $30,000 worth the additional risk? Because here's what these projections don't show. Risk. Perth's growth has been driven by a strong cycle fueled by mining-related demand and interstate migration. If commodity prices soften or migration slows, that 6 to 8% growth could quickly drop to 2 to 3% or even turn negative. Melbourne's lower growth, on the other hand, might actually be more sustainable. It's not dependent on a single economic driver. Population growth fundamentals remain strong over the long term. And historically, Melbourne has shown more consistent performance across full property cycles. So the real question becomes, do you want to chase potentially higher returns in Perth, knowing you're taking on more cyclical risk? Or do you prefer the steadier, more predictable path that Melbourne offers? If you're looking for capital growth over the next 2 to 3 years and you're comfortable with higher risk, Perth's outer ring suburbs offer compelling opportunities. Places like Ellenbrook, Baldivis, and Byford are showing strong momentum with decent yields. The key is timing. Perth appears to be in the middle of a growth cycle, so you're not buying at the bottom, but you're also not buying at the peak. If cash flow is your priority, Perth again has the edge. Yields across most segments are 0.5% to 1% higher than comparable Melbourne suburbs. That might not sound like much, but on the 600K property, that's an extra $3,000 to $6,000 per year. If you prefer stability and long-term growth over short-term gains, Melbourne fundamentals are more predictable. The population growth is more sustainable, the economy is more diversified, and while growth might be slower, it's potentially more reliable. The key is aligning your choice with your investment timeline, risk tolerance, and overall strategy. Don't just chase the highest returns, choose the market that fits your investment profile. Before I wrap up, I must mention that this analysis is based on the current market conditions. And as we've seen, property cycles can shift quickly. The Perth suburbs I've shown you today might look completely different in 6 months if mining conditions change. Melbourne's recovery could accelerate faster than expected if population growth picks up or interest rates drop more than anticipated. That's exactly the kind of analysis SuburbsFinder was built for. Instead of relying on quarterly reports or annual reviews, you can monitor both Perth and Melbourne markets in real time, meaning you can track vacancy rates, price momentum, rental yields, and days on market across every suburbs in both cities. The platform lets you compare suburbs side by side, set up alerts when the market conditions change, and most importantly, spot opportunities before they become obvious to everyone else. I've set up a free trial for serious investors through the link in the descriptions below. You can dive deeper into the Perth and Melbourne suburbs I mentioned today, plus analyze dozens of others based on your specific criteria and investment strategy. Market cycles don't wait for anyone. Question is whether you'll have the data to position yourself ahead of the next wave of opportunity. Again, this is Gilbert, founder of SuburbsFinder. See you in the next video.